This is my beginner's guide on how to not only make money during the 2025 crypto bull run, but more importantly, how to hang on to it and actually cash out at the end of the cycle for life-changing gains. I was able to successfully navigate the last crypto bull run, selling near the top and buying back in with my entire net worth just weeks from the exact bottom of the market. In fact, I'm starting this crypto bull run with more money to invest than I had at the absolute peak of last crypto bull run. And that's primarily due to the insane gains I've been able to make already during the crypto bear market. In this video, I'm gonna go through all the common mistakes that most people make during a crypto bull run, how to position yourself so you're able to successfully exit the market in profit instead of riding it all the way back down to the bottom, the extremely common bad advice that I see spread all over TikTok and YouTube that will leave you penniless at the end of this cycle, and overall, how to form a bull market battle plan that'll keep you safe even when things go absolutely bananas. And please pay attention to this video because this could be the difference between you leaving the bull market with life-changing gains and you leaving the bull market absolutely broke. I've been investing in crypto for the last 7 years. Along the way, I have learned a ton about how to invest in crypto and how not to invest in crypto. In 2017, I got absolutely wrecked because I did all the same things that most people do when investing in crypto. In 2021, I made an absolute fortune because I came back and I learned from those mistakes to do a better job. And I have worked my butt off since 2021 and learned 1,000x more than even what I knew back then. And this video is my genuine attempt to share all of that knowledge, that 7 years of knowledge, everything I've learned with those who are just a little bit patient and willing to sit down and listen. If that's you and you're willing to be a little bit patient, this is going to be one of the most valuable videos you'll ever watch. Okay, to start off, let's start with how bull markets work. I've already explained this like a million times on my channel, but it's always worth revisiting. Okay, so crypto bull runs always start with Bitcoin going up first. And it's not a hard and fast rule. There are other crypto projects that also pop off over this time, but in general, Bitcoin is the market leader. It is what everything else in the market is following, and it overall kind of remains dominant in the market. And eventually it gets to a place where Bitcoin is so high, it's so big, that a lot of people feel like they've missed the opportunity, they've missed the boat. It's too late to get into Bitcoin because it's already up so high. And I know I just talked about this in a recent video I did about altcoins. Please just bear with me. Again, it's worth always revisiting this. So people feel like they missed the boat when it comes to Bitcoin and they look for the next best opportunity. And typically they're looking up to 3 degrees of separation. So they might look at Ethereum or just in general, the bigger blue chip cryptos, or retail returning back in the market might look at the bigger cryptos that they were into last cycle that maybe are older and outdated, but they're like the things that they were excited about last time they checked into crypto. So they're just jumping back into those things. This is why recently you saw things like Cardano, XRP, EOS, and some of these older kind of legacy tokens from 2017 popping off. It's really kind of nuanced, but in general, you get the idea. It's like these bigger blue chip tokens that the market typically looks at as beta or as like a second opportunity if they missed out on getting into Bitcoin. And kind of uniquely positioned and almost like a linchpin asset in this second wave is Ethereum. If you look at the 2017 cycle, you look at the 2021 cycle, Bitcoin initially leads the charge, and then following up is typically Ethereum. And even though maybe in percentage terms, it's not going to go up as much as some of the smaller assets that are much smaller, it leads the market in terms of like overall, just kind of like money coming in. For example, Bitcoin is a $1.9 trillion asset. For it to go up just 30%, it would have to add $590 billion to its own market cap. That's bigger than the entire market cap of Ethereum is having to add to just go up 30%. So right now, Bitcoin by far is bringing the most capital into the market via its appreciation, even though there might be smaller tokens that are going up more in percentage terms. By and far, the vast majority of capital is coming in through Bitcoin right now. Well, during the second wave, Ethereum ends up kind of taking that mantle or that momentum, even though maybe in some cases, Bitcoin is still bringing in the most capital. Because of the way ETH is tied into the rest of the crypto ecosystem, when Ethereum goes up, it has an outsized effect on everything else going up as well. So Ethereum kind of takes over the momentum of the bull market because as it's appreciating, it's building up all this wealth that eventually ends up exploding out into all the different various altcoins. And I think there's a strong case that this time is not going to be any different. Ethereum's still the second largest asset, and Ethereum is also the only asset outside of Bitcoin that has an ETF this cycle. And that means institutional capital can really only go in through 2 doors. It's got the Bitcoin ETF and it's got the Ethereum ETF. And after Bitcoin has gone up enough, this institutional capital is going to be a little bit hesitant to touch the Bitcoin ETF. And they're going to look at the ETH ETF relative to these things and say, hey, maybe I'll put a little bit over here in case this one goes up as well. Again, very, very good for the rest of crypto because as ETH appreciates in price, so too does everything else. And again, after ETH has skyrocketed in value, people are going to look around and they're going to say, hey, I missed out on Bitcoin. I missed out on ETH. But maybe this other asset that's kind of similar will go up next. And so they look at, again, things up to 3 degrees of separation. So they might look at Polygon. They might look at Optimism. They might look at ZK Sync. They might also look at things like Uniswap or Aave or, kind of other things loosely correlated or connected into Ethereum. And again, this process just repeats and repeats and repeats. And it ends up accelerating the lower you go down the stack. And that's because, if you put $1 billion into Bitcoin, it's not going to move the price at all. But the lower you go down the stack, if you put $1 billion into some of these tokens that are sitting at $10 million in market cap, that is generating some insane gains for those that were there early. And insane gains generate crazy headlines and mania and a lot of people wanting to get into crypto, which is what ends up bringing each successive wave into the market who, again, feel like they've shown up late and they're like, oh, I missed out on these opportunities. I wonder what will go up next. Maybe this thing that's smaller, that's somewhat related, will be the thing that goes up next. And this just keeps going until all the somewhat decent projects end up, pumping in price. And eventually the last wave is stuck with all the bottom feeder kind of Ponzi garbage. And they end up jumping into that. Those things go bananas, make people a ton of money, and then the whole system ends up collapsing. And this plays out like clockwork every single time because of the psychology behind it. And that's why you can rely on it to happen every single time. Although administrations change and policy changes and market changes, psychology doesn't change. It's been the same for thousands of years. And people can be relied on to behave in near the exact same way given the same circumstances. Once you understand this basic principle, that the constant in the market is human psychology, you have a huge edge on the rest of the market because it's a constant you can reliably use to predict future outcomes. This is where the famous quote from Warren Buffett comes from: be greedy when others are fearful, be fearful when others are greedy. You can guess that when markets are in peak fear and people are acting, irrationally fearful, that it's going to be an opportune time to buy because the markets are pricing things too low. People are, in a panic mode, they've oversold and it's a good time to get in. You can also guess when markets are at peak euphoria and everyone's extremely greedy, everyone's saying we're going higher, they're throwing in their life savings, that it's probably a good time to sell because the markets have overpriced to the upside. And when that corrects, it's going to correct hard. Okay, so you understand the basics of like how on a macro scale, crypto bull markets work with the rotation from Bitcoin down to Ethereum, down to the alts, down to the lesser alts and the Ponzi's, etc. I think there's a decent amount of people that kind of understand the basics of how that works. What a lot of people don't understand is that not only does that play out on like a macro scale, but it also plays out with these mini bull run rotations that happen throughout the bear market and throughout the bull market. For example, during a bull market, you might have a narrative or a sector that ends up gaining a lot of hype and attention. Last cycle, this was things like the metaverse, NFTs, etc. This cycle, it's like real world assets, DePIN, AI, etc. You have these narratives or these sectors that gain a lot of attention and a lot of hype, and it ends up causing this mini rotation, like what we see on the macro scale, but on a micro level. For example, during the bear market, Solana got a ton of attention because the price of Sol, or because Sol was going up a lot. It was appreciating in value. This brought a lot of attention to the Solana ecosystem, and this caused a mini bull run around the Solana ecosystem, where people did the exact same thing that they do on a macro scale, but with specific to Solana, where they looked at Solana and they said, hey, I feel like I've missed out on this Solana play. But I wonder what will go. I wonder if this other thing within the Solana ecosystem will go up next. And at the time, there wasn't a ton of like good alts to play on Solana. So, but the ones that were there ended up going up. You had NFTs on Solana end up going like popping off like crazy. I had a $2,000 Mad Lad NFT that went to $30,000. And because there wasn't a ton of plays within the Solana ecosystem, it went all the way straight down to meme coins. And then you had this crazy meme coin mania that ended up sparking off on Solana. So you can see the same psychology, the same rotation happening on a mini scale. We also recently saw Doge skyrocket, and this is due to Elon Musk's Department of Government Efficiency. Once Trump won, everyone knew we were going to be talking about that for the next 4 years. They figured, hey, that probably means Dogecoin is going to go up because it's going to get so much attention. A lot of people bought into Doge. After Doge had sufficiently gone up, people looked at it and they said, hey, Doge has gone up a ton of value. I missed out on that opportunity. I wonder if, Pepe is going to go up next. So people bought Pepe, they bought WIF, and it rotated all the way down through all the different various meme coin sectors. You get the idea. There are macro rotations for the overall crypto bull market. And then there are mini rotations for specific sectors and narratives that gain a lot of traction and attention. Okay, that's like foundational for understanding how the crypto bull market works. And I hope I've given you like a good 1,000-foot overview of that. You understand it. And now that you see it, you're going to see it everywhere. Next up, let's talk about a common massive mistake that'll strip you of every penny you have if you don't understand it. Most people are permanently stuck following the trend. Their primary way they invest is just in whatever's popular at any given moment. If everyone's talking about memes, they're going to go invest into memes. If everyone's talking about DeSci, they're going to go invest into DeSci. If everyone's talking about crypto AI, they're going to go look at what crypto AI tokens they should buy. Most people rotate their capital into whatever like the flavor of the week is, hoping to get rich. And this is not how you make money investing, unless you're like an extremely talented day trader and you're working on an entire different system and battle plan. As a whole, this is a horrible way to invest. The way you make a fortune investing is by investing before it's popular and before everyone is investing into that thing, not after it's already popular. This seems like it should be extremely common sense, but for whatever reason, people just don't do this. That's probably because it takes conviction to invest into something when nobody cares about it, nobody's talking about it, and price isn't going up. And in order to have conviction, you have to actually understand, kind of a little bit about how the markets work. You have to understand an asset and like maybe have a thesis behind why it's going to go up in the future. The average person just isn't going to take the time to do all these things. And again, it comes back to psychology. Instead, they're relying on a mental shortcut of looking around and seeing what is popular and everyone else is doing to try to figure out what's a good place to put their money. This is something that's just wired into people. And if you think about it, like from a survival standpoint, it does actually make sense that if you're looking where to get water from, maybe it's probably the place where, everyone else is getting water from. Or if you're looking for like the safe food to eat, it's going to be, the berries and the things that everyone else is eating. Herd mentality is a good thing when it comes to survival and not dying, but it's a horrible thing when it comes to investing. In order to be the one that succeeds when it comes to investing, you need to be the pioneer. That might be, like I talked about earlier, simply buying when it's max fear and selling when it's max greed. But it also might mean outworking the market by studying first principles. Things like, what is crypto? What actually makes it useful? Where is it going? Where is real profit and revenue being generated? Where are the real world use cases that actually make sense? What sectors are the most likely to generate hype during a bull run? What are super sticky narratives that can easily spread and go viral? Once you've identified the traits you're looking for, you can buy early before everyone else has jumped in and before there's a lot of hype around it, and then wait for your thesis to hopefully play out. Okay, speaking of first principles, it's good to understand why we have bull markets in the first place. Why do we have these parabolic run-ups that we see every 4 years where price explodes and everything goes crazy? Like, what is the catalyst pushing that price up? Also, why do we collapse at the end of a bull market? Why is it that we have not only this parabolic run-up every 4 years, but then this massive collapse after? What is triggering those two things? And to understand why we have this, I like to give this analogy that I think helps make more sense of it. Imagine you have this like warrior back in like the days of like the samurai, right? And this warrior goes off to battle. It's like this crazy battle. Nobody expects him to survive, but he does. He comes back and he survives and he's a hero. And then imagine this warrior goes off to another battle and comes back and survives, and another battle and another battle and another battle. And every battle this warrior goes off into, no matter how stacked the odds are, this warrior always survives, always triumphs and comes back. The more times this warrior does this, the more people are going to start to believe that this warrior cannot be defeated. And this is kind of like when the price of Bitcoin collapses, but then recovers to go even higher. Every time this happens, people's confidence in the ability for Bitcoin to recover and go higher increases. And after a long enough period of time where Bitcoin's doing this, people start to believe that the price of Bitcoin can go up only. Just like in the warrior analogy, people start to believe that this guy's immortal and he can't be defeated. If you have an asset that genuinely you believe can go up only, what logical next steps would make sense for you to do? Well, if you genuinely did have an asset that could go up, like only went up, like it was an asset that only went up, it would actually make sense for you to be like, hey, I'm going to take out my extra life savings and put it in this asset. Maybe I'll mortgage my house and put it in this asset. Maybe I'll take out some credit card debt and put it in this asset because it can only go up. Why wouldn't I do that? Why wouldn't I leverage myself to the max? Because if it was an asset that only went up, that makes sense. That's such an easy way to make money. And this is what people start to do. They start to believe that Bitcoin can only go up. And it starts to make more and more sense to them to pile more and more of their money, their emergency savings, their and take out credit card debt, mortgage their house, etc., take out leverage to put more money into Bitcoin, because why wouldn't they if they believe that this thing can only go up? This, in a nutshell, is why we have these crazy mania phases in a crypto bull market. As Bitcoin keeps going up and up, people start to believe that it can only go up, and they start putting more and more money in it. And as time goes on, eventually leverage enters the system, causing the price to go absolutely parabolic. But that same leverage ultimately becomes the underpinnings for what causes the market to collapse at the very end. As more and more leverage enters the system, the market becomes more and more unstable, to where eventually it only takes this little push to cause the entire house of cards to come falling down. Thus, as long as Bitcoin continues to slowly go up, we will eventually have some sort of mania phase, because eventually people will believe, just like the warrior who comes back from battle over and over again, that it's going to always continue to go up. Just look at what Michael Saylor's doing and a lot of the talk that you're seeing even right now in the market. And no matter how many times people talk about a super cycle, or how much they talk about how they want it to keep going up and more people are coming, etc., eventually this will always lead to an end of market collapse. And I know it might feel like I'm kind of all over the place with some of these things I'm talking about, but I swear these first principles are crucial for building your basic understanding and conviction in the market and the market system and why these things happen, so that you can therefore go on to succeed, because you kind of see the matrix, right? It gives you a deeper understanding than most people about like the why as to what's causing these things. And that allows you to see ahead further than most people and allows you to ultimately win. Next, let's talk about one of the single most important things when it comes to winning in a crypto bull market that it's extremely underrated, and that's position sizing. This is a key ingredient when it comes to winning and not absolutely getting wrecked during the bull run. Most people just throw their money around into projects based on their mood and emotions at the time that they're deciding to invest in this thing. This is a losing strategy. If you do this strategy long enough, you will eventually end up at zero. It is just a overall horrible way to invest. Instead, the secret to managing your risk well is position sizing. Personally, no matter how bullish I am on a project, I will never invest more than 5% of my portfolio into that project. Even if I think this is a for sure in the bag, 1000x play, this is the next Bitcoin, it's gonna take over the world. I know for like 100% sure this is gonna be a win. Even if I feel that, I still will only invest up to 5% of my portfolio into that position. The reason is because I can and will be wrong sometimes. By definition, when investing, you're dealing with a lot of unknown variables. I personally like to compare it to poker. Your research and understanding of the market and this project, etc., is like understanding the starting cards you're holding in a game of poker. It allows you to look at your starting hand and say, this is a good hand, or this is a bad hand, or this is an amazing hand, or this is a horrible hand, which is obviously an extremely helpful thing. If you don't even know how good your starting hand is, you're just guessing, when you're placing these bets, and you're probably going to lose everything. But even if you do understand your starting hand and it's an amazing, it's actually the best starting hand you could physically get in a game of poker, that doesn't mean that you're going to win. And that's because there's unknown variables when it comes to that game. You don't know what cards are going to get flipped up on the table. So while you might start out with an amazing starting hand, it can end up being a horrible hand based on the cards that are flipped over on the table. When you're dealing with unknown variables, you have to limit your risk per bet. I always expect 6 out of my 10 investments to outright fail, 2 to do okay, 1 to hopefully do really good, and hopefully 1 to do amazing. And if you don't understand that, let's imagine it like this. Imagine you have 10 different crypto projects and you put $1,000 into each one. Now let's imagine 6 out of 10 go to zero. 2 out of 10 go up a measly 30%, which is small by crypto standards. 1 out of 10 does a 3x, which is pretty decent. And let's say 1 out of 10 does a 20x, which this happened with me this cycle with the Kosh. I started with $10,000 and now I have $25,600. Even though I lost on the majority of my plays, I still ended up making a massive profit. And these numbers are super conservative. I'm not losing on 60% of my plays, but I build my strategy with the idea that could happen so that I'm always protected. Also, in reality, I would never do like standard 1,000 into all 10 positions like that. Instead, I'll do 5% for like my highest conviction plays. Like I think I'm like super bullish on these plays. I'll put in a max of 5%. For my like mid conviction plays, I'll do around 3%. Kind of just depends on, some of it's kind of like a gut feeling, but for my mid conviction plays, I'll do around 3% of my portfolio into those. For my like lower conviction plays, I'll do around 1% of my portfolio into them, or maybe they're high conviction, maybe they're like a high risk as well. So I'll do like 1%. And typically I'll do 0.5% or less, oftentimes a lot less, for like my Hail Mary, like wild card, super risky, I'm really unsure plays. And that's all you really need to do in crypto. You don't need to over allocate into any one single position. I've had $760 investments in crypto turn into over $150,000 while I was taking profit along the way. I recently had a $3,000 investment turn into over $3 million, which there's some nuances to that. That was on, like, my wallet balance said $3 million. I couldn't actually cash out for $3 million because the way liquidity works. That's a whole nother lesson for a whole nother time. The point is, you don't need a lot to make a lot, but you do need to manage your risk and guard your capital well. Because if you run out of capital, it's game over. The trick to winning in crypto is to stay in the game. Now, one of the biggest shifts from a bear market into a bull market is this shift from PvP season to fastest horse season. Understanding this shift and positioning correctly can make you a fortune. And I'm going to get into that in just a second, but really quick. The Obsidian Council is my private research community where I share monthly research, my entire portfolio, buy and sell alerts whenever I buy into a project, and more. We've had projects go up 1,100%, 1,200%, 1,500%, and some much more. I spend a lot of money to access a variety of newsletters, private groups, and more so I can get the best alpha in the market. And I share that alpha with the members of the Obsidian Council. Currently, the Obsidian Council is sold out and closed to new members. But if you want to join next time it opens up, make sure to join the waitlist in the description of this video. So during a bull market, we switch from PvP season to fastest horse season. PvP is basically when the market's just rotating capital in and out of whatever the narrative of the month is. And during this season, you might, 1 month watch your investments skyrocket, only to watch them come all the way back down the next month. Attention is scarce, liquidity is spread out, and rotations are fickle. This completely changes during a bull run. Instead, we switch to what's called fastest horse season. In this environment, the gains are a lot more sticky. Most decent projects end up going up, and it's a lot less about will I make money investing into this like somewhat decent project, and more about what investment's going to make me the most money or opportunity cost. You often, during a bull market, will have people that are miserable after they've done like a 3x on their investment because the token that they almost bought did a 300x. The psychology of this stage is that people are overall optimistic about the markets and overall greedy. They're looking for the fastest horse. They're looking for the thing that's going to make them the most money physically possible. And they're far less worried about tokens going down in price than they were back in the bear market. In this market, you want to front run the stickiest and the most viral narratives before they take off, because those tend to be where the fastest horse ends up emerging. And as I talked about earlier, this involves taking some risk and investing into things before they have hype and attention. And to be clear, there's a lot of garbage projects that just aren't going to go up. So you can't just go pick a random project that nobody's paying attention to, put money in it, and then be like, oh, it's going to go up in the future. You have to use various filters to try to identify the project that will end up taking off. And for me, the most powerful filter that I'm looking for is, does this have a sticky narrative? Is this a good story? And does this story and this narrative around this project have some level of virality around it? Now, during this phase, as people are looking for this fastest horse, they tend to overtrade. And most of the time doing this ends up being a mistake. You end up getting caught up in what we talked about earlier, where you're just kind of like following the trend and you're following, sort of like the narrative of the month or whatever's hot. And you end up just kind of playing whack-a-mole with all these various trades and overall losing. Another common mistake people end up making during a bull market is they end up selling way too early. Early on in the bull market, they underestimate how insane frothy things can get. One thing you have to understand about bull markets and the mania phase specifically when it comes to crypto is things get really frothy. They disconnect from reality. Prices go way too high way higher than they should. It doesn't make logical sense. People are really greedy. They're trying to make a ton of money and they'll push kind of stupid tokens to these insane heights where obviously it's going to come crashing down eventually. But riding that thing up is one of the best money-making opportunities on the planet. And this one is kind of hard because obviously it's never a bad thing to take profits. But what I found with these people that end up doing this is they'll sell early. They'll miss out on this insane gain that they could have made. That's an extremely painful experience when you miss out on something that could have changed your life. And you end up like psychologically getting into this weird kind of funk where you're trying to catch up trade against what you could have made. And you end up doing all these stupid things and making all these stupid mistakes and eventually losing all your money because of it. So it's never bad to take profit. Just make sure you have a plan and you're careful with it. This is overall why it's really important to have some sort of profit-taking strategy that you're just going to stick to for the majority of the bull market. For example, during like a late stage bull market, I typically will take out my initial once an investment has doubled or tripled. So if I put $5,000 into an investment, it turned into $10,000 or $15,000, depending on how fast it did that, I'll take out my initial $5,000. That way I can't lose my initial, and I'll just typically let that thing run or cash it out when I kind of feel like maybe we're at a top. And this allows me to de-risk early on and just control my emotions. And I think for a lot of people, this is probably just a solid strategy all bull market, is that after it doubles or triples, take your initial out, That'll allow you to detach your emotions from that thing. You won't lose money because your initial is out, it's sitting safe somewhere. And you can more easily ride that thing to gains or losses, or it doesn't even matter at that point because again, you're not going to lose your initial at that point. But especially late stage, this like saved me from so many potentially bad trades that ended up just doing horribly later on because I took my initial out early. That saved me from, losing a lot of money. Along these same lines, it's important to understand that as the bull market gets more and more intense, you're going to have more and more volatility. Meaning you'll have like these insane run-ups one day, only for like the next day to everything to crash and everyone's going to be telling you to sell. We're going way lower, etc. And then the next day it goes even higher. And people that end up selling at the bottom, they get kind of cut off from the rest of the bull market, waiting for it to come back down, and it never does. This can be extremely painful and again, lead you to do some really stupid stuff later in the cycle. It's really, really hard to time the market, and overall, it's just better to sit through it. Even if you think the market's about to dip or it's about to go lower, if you don't think it's the end of the bull cycle and we're going way higher and we have a lot longer to go on the bull cycle, then it's better just to kind of hold through that dip because you might be wrong about that dip. Or you might mistime it, or there's just so many ways to find yourself on the sidelines. Now, if you've already made a life-changing amount of money and you're just like, you're okay being on the sidelines and not catching the next leg up, even if we double or triple or whatever, then that's fine. Like, no worries there. But make sure you kind of understand yourself and if that's going to really bother you and cause a ton of pain, because if it does, it's going to warp your kind of perception and cause you to do some really, really stupid things later on. You should also have an overall selling strategy for like the entire bull market. Basically, at what stage in the bull market are you going to completely exit the markets, take your money off the table, and you're done? Remember, during a bear market, fear takes control. That's like the big boss during a bear market is fear. And if you can overcome your fear, you're able to get in at the absolute bottom prices. During a bull market, greed takes over. And you have to overcome your greed in order to sell at the absolute top. It'll likely feel like it's the absolute stupidest time to sell when it's the perfect time to sell. My strategy to kind of overcome maybe not trusting myself to sell at the right time is that when I think it's the top, my plan is to sell 1/3 of my portfolio. So when I think that we've hit the top, like all my alarm bells are going off, my spidey sense is tingling, I'm going to sell 1/3 of my portfolio. That way, if I'm wrong and we go higher, I still have 2/3 of my portfolio sitting in the market, and I'm not like experiencing this mass like FOMO on the sidelines because I have all this pain. But if I'm right and we go lower, I've taken 1/3 of my portfolio off the table and I've preserved some of my capital. And my plan is that, when I get my second confirmation that like, yes, this is definitely the top, I feel it again, like this is for sure the top, I'm even more convicted, I'll sell my second, third. And then when I get my third confirmation of like, this definitely is the top, I know without a doubt, I'll sell my final third and I'll be completely out of the market. It's basically like a reverse DCA strategy. It also helps to have sort of like a fun bucket during this stage of the market. Often when the market is like having its like dying breaths and like its last gasps of life, there's all sorts of like really crazy fun opportunities to make life-changing amounts of money. Usually with Ponzi's, memes, and lots of other high-risk plays where you're likely to lose all your money. Having a fun bucket where you have like 2% of your capital or 3% of your capital that you're just gonna mess around with these things and kind of stay attentive to the market is a good way to overcome your FOMO of like completely stepping out of the market, stay involved, and maybe end up making a little bit extra at the end, while also protecting the overwhelming majority of your capital and making sure that you're not gonna gamble that all away going into the bear market. Now, so far, I've talked about a lot of different trading errors that will leave you penniless, but I've seen people trade perfectly and still lose all their money, making a completely different set of mistakes. And that's not having proper security hygiene. As the crypto market heats up, so do the amount of scammers that are trying to steal all your money through various schemes. In crypto, you should always be paranoid when it comes to security. That means if you have more than $1,000 invested, spending $80 to get a hardware wallet, it's just like an extra layer of protection when it comes to investing. That means having your seed phrase backed up in a physical location, never digitally. That means having two-factor authentication on all your email addresses, all your accounts, etc. It means being insanely suspicious of any links that are sent to you and being hyper paranoid when it comes to clicking those links. Oftentimes I'll copy the link, I'll paste it, I'll read through it, I make sure it matches where it's supposed to go. And even then, like I typically won't open it on my computer that I'm trading with. Maybe I'll open it on a separate computer or my phone just to check it and make sure. It means using Ravi Wallet or Phantom Wallet. These wallets both have built-in security features that you aren't going to get in some of the other wallets that I think are crucial to not getting hacked. It means never using text-based two-factor authentication because it's just way too easy for people to social engineer their way into getting a SIM swap on your account. This happens all the time where somebody will call up your phone company. They know you trade crypto somehow, it's some sort of data leak. And then they'll call your phone company and they'll get them to say that they're you, and they'll get them to switch your SIM card to their phone. and then they'll use the two-factor to hack into your account and steal all your money. This has happened so many times, it's ridiculous. So don't use text two-factor either. Overall, it pays to be insane paranoid when it comes to crypto security and take zero risks. I personally like to use cold storage addresses for the majority of my funds, where what I'll do is I'll have my active trading addresses where I'll maybe use DEXs or do DeFi stuff, etc. And then I'll have cold storage addresses. And these are addresses I only use to send things in and send things out and never sign anything else with those addresses. That way, if I were to ever sign like some sort of malicious transaction, they can never drain those funds. Another really common mistake that a lot of people make during a bull market is trying to copy trade YouTubers, TikTokers, and in general influencers. If you don't actually take the time to do the research and build your own conviction on a position, don't be surprised if you end up losing on that position while others are winning on that position. There are countless people that have lost fortunes investing in Bitcoin, despite the fact that on the overall time frame, it's basically gone up only. Even on great trades that end up succeeding, you can lose money if you don't know what you're doing. Okay, on Memecoins and Ponzi's, there will be people this cycle who make a fortune, like life-changing amounts of money investing in Ponzi's and Memecoins. But the vast majority of people who invest in these things are going to lose. Memecoins specifically, I like to compare to lotto tickets. If you're just having fun and you know you're just basically gambling, that's okay. But do not treat them as a form of investing. The exceptions would be things like Doge or like some of these really, really big meme coins. There is an amount of fundamentals to those things where maybe you could place bets with some sort of thesis where it makes sense. But most meme coins, especially the small cap meme coins, they have a really short lifespan. Typically, the narratives around these meme coins will last like a couple days to a week before everyone rotates out of it into the next thing. If you're just throwing money into memes you think are funny or you heard about on TikTok or your friend told you to invest in, don't be surprised if you end up getting wrecked and losing everything. Let's talk about fear and greed tactics. There are always going to be people trying to manipulate you toward either fear or greed in a bull market. People who are invested into a project are going to try to get you to join their project. That's because they want everyone to join their project, because if everyone joins, they'll be rich. On the other side of the spectrum, you're going to have people who had previously invested into a project but sold. And they're going to work to sow fear, uncertainty, and doubt about that project, because basically their worst nightmare is that they sold that project and then it ends up skyrocketing and they were wrong. These are basically yin and yang. Both will always exist for any given project. And in most cases, both are going to have really convincing arguments for their side of why they think you should buy and why they think you should not buy, and stay as far away from it as you can. And your job during a bull market is to become really good at understanding who's right and who's wrong. Otherwise, you'll end up being like everyone else in a bear market, where you're thrown around by every stray comment or post about that project. On risk and reward, as a basic rule of thumb, the bigger the risk, the bigger the potential gain. The less risk you take, the less the potential gain. During a bull market, you have to decide which approach is the right approach for you. The ultimate goal of any trader is to find a play that's a low risk play because of the fundamentals and the basic setup, but that has tons of upside because it's not yet discovered by the market. Those are like the hidden gems of the crypto market. They're extremely difficult to find, but there's always one of them sitting out there somewhere. And obviously, if you're able to get good at finding those, you'll end up making a fortune. One thing you're going to want to put a really heavy emphasis on when it comes to trading a bull market is finding a strategy that suits you specifically. Overall, when it comes to investing, it pays to know your own personal weaknesses and strengths. Some people thrive doing active day trading, and other people thrive doing long buy and hold patterns. Some people thrive with complicated strategies, and some people thrive with simple strategies. You need to figure out what works for you, because there really is no one size fits all. Finally, let's talk about the best sources of alpha and information. As a general rule, TikTok is an absolute garbage heap when it comes to getting good alpha and information. TikTok is almost pure retail. It's like a window into the minds of what retail traders think. And retail will always lose. They are by definition the equivalent of the average trader, and the average trader is never going to be the one that makes millions and millions of dollars investing. YouTube is a bit better, but it tends to skew more retail than not. Obviously, I'm on YouTube and I think my own content is great. And I'm not the only one. There are really good creators on YouTube who put out really good thoughts and insights. But as a basic rule, there's also just a ton of garbage on YouTube. Podcasts are a great source of alpha and information. The guests are generally more experienced investors or professionals who actually have accomplished something when it comes to the markets or building something, etc. They usually have a lot deeper insights, more well thought out theses, and in general, it's just a lot higher quality information. Some of my favorites are Bankless, 1000X, Forward Guidance, All In, Good Game, On the Brink, and of course my own, the 1 to 1 Million podcast. Twitter is another great source of alpha and it's really where most alpha originates. And I'd add that Farcaster is also another good source of alpha, and there's like a lot of really high quality devs and just like crypto people on Farcaster. Lastly, Discord also can be an amazing source of alpha if you're in the right communities. Again, just another reminder, if you want to join the Obsidian Council, make sure to check out the link in the description of this video if you want to jump on the waitlist. Make sure to sign up for my free weekly crypto newsletter. It's mostly just all my content I put out each week in an easy email so you don't miss it, but occasionally I drop some other cool stuff in there as well, including sometimes I mention things I'm buying before I ever talk about it on my YouTube channel. Also, if you really want to dive deep, make sure to check out my weekly podcast, the 1 to 1 Million podcast. I interview projects, talk about the markets, and interview various traders and experts in the crypto space. As always, none of this was investment advice. This is me taking all my thoughts and the things I've learned and distilling it down into like a cool beginner's guide, but it's more like a Pinterest board of my thoughts and information. It's up to you to kind of like sift through it and use and take what are going to be applicable to you. If this video is helpful, make sure to hit that like button. If you have any questions or anything to add, let me know in the comments below. And if you want to see more videos like this, make sure to hit that subscribe button and the little bell next to it to be notified each time I release a new video. Thanks for watching, and I'll see you next week.